Hi, everyone. Welcome to Eyes Wide Open Viewer Trade Clinic. I'm Patricia Saylor, Managing Partner of Saylor Financial Fundamentals. In this series, I analyze specific trades, just like I do with my one-on-one coaching clients. Today, I'm answering a question from Ignacio in Dallas, Texas, about his current position on HIMS. He's new to options trading and wants to generate extra income while lowering the cost of shares he wants to own, all while staying mindful of risk. Ignacio wrote, I have 200 shares of HIMS in my account that I bought for $30.60 a share. Today, it's trading around $37, but it's been as high as $72 recently, and I'm kicking myself for not selling then and taking profits. I like the stock and think it will do well long term, but I wonder if I should take some profits in case it keeps dropping. I have about $3,000 cash available to add to this position. I'm just not sure what to do. I'm looking at a cash secured put with a $35 strike that expires in about a month and maybe a covered call. What are the risks and possible outcomes? Great questions, Ignacio. Let's break this down and explore ways that you can lock in some gains, reduce your break-even price, and hold on to some shares for future upside. When I'm trading something that could go any kind of way, I like to approach it from multiple angles. Hold some shares for long-term growth, sell some shares to lock in capital gains when I can, sell puts for income and to dollar cost average down if I'm assigned, sell covered calls for income, and to take higher profits if I'm assigned. Each of these strategies can strengthen your position. Since you're unsure which way to go, I'll use them all to help you reduce your cost basis, set up to buy more if the price drops, and take profits if the price increases. Let's get to trading. If you follow my trading strategy, you know that often what is displayed in the account does not convey the whole picture. So let's go back and look at Ignacio's trade history with this position. Beginning in December of 2024, Ignacio sold a cash secured put, rolled it out for more income, and then bought 100 shares when the price of HIMS dropped. He then sold a covered call with a strike price of 32, and he brought in another $84.34, and then was assigned to buy 100 shares, paying $31 a share for them. So when we add all of that expense and income up, he's really out of pocket only $5,944.64. Divided by the 200 shares he owns shows that his average investment per share is $29.72. Let's take a look at the March 21st expiration date for a cash secured put with a $35 strike. Ignacio can bring in $146 or $148 by selling this put, but in order to secure it, he will need $3,500 rather than just $3,000. Selling 13 shares will raise enough cash for Ignacio to sell a $35 cash secured put. But since he has expressed some doubt about which way this trade is going to go, let's sell 35 shares to lock in a little more profit. The order filled at $38 a share. Now let's sell the cash secured put with a strike price of 35. That filled at $1.68 per share. Ignacio will need $3,500 to secure it, which results in a very high annualized rate of return of 116.34. If he were not willing to add to his position, this would be an unnecessarily risky trade, but since he would not mind adding more shares, this will just reduce the cost basis if the shares are assigned to him. Let's see where things stand, and then we'll choose a strike price for Ignacio to sell a covered call. Right now, Ignacio is out of pocket $4,447.30 and owns 165 shares for an average investment per share of $26.95. But remember, he is at risk of being assigned to buy another 100 shares, paying $3,500 for them. With the same expiration date of March 21st, I see a $45 covered call with a bid of 80 cents a share. So I'm going to go ahead and sell that. It filled at 84. For the final piece of this analysis, let's look at what might happen if either of these two options contracts goes in the money. And remember, because they expire the same day and the cash secured put strike is lower than the covered call, they can't both go in the money at the same time. If on March 21st, the share price is between $35 and $45, both of these contracts will expire and Ignacio will still have 165 shares. But if the cash secured put goes in the money, for example, if the share price drops to $34, then he will be assigned to buy 100 shares, paying $35 per share for them. And if the covered call goes in the money, for example, if the share price goes up to 46 or even back up to 72 where it was at one point, then Ignacio will be required to sell 100 shares and he will receive $45 per share. So one of these two things could happen, but they can't both happen. So let's analyze a possible assignment to buy 100 shares. If that happens, Ignacio will be out of pocket $7,863.96, and he will own 265 shares. So he will have an average investment per share of $29.67. If the share price rises above $45 per share, he will sell 100 shares and receive $4,500. At that point, he will have a profit of $136 and he will still own 65 shares. So it's up to you, Ignacio. Do you want to assume the risk of owning 265 shares at an average cost to you of less than $30? Or would you be willing to risk having 100 more shares called away, making a profit, and still holding 65 shares in your account? For me, either one of those would be a perfectly fine outcome. I hope you'll let us know what you decide to do.